All right, welcome. My name is Brian Steiner. I am NAIFA's Vice President of Business Development. Today, we are very excited to have the Chief Marketing Officer, David Morris, who's going to be moderating a panel of thought leaders and drivers in the insurance and financial services industry, and specifically the fintech space. Very excited about our partnership with Proformex, and as an organization with NAIFA, I've had unbelievable engagement with all of our participants on our panel today. Before I turn it over to David, just a few quick housekeeping items. All attendees are in listen-only mode. If you do have questions throughout the program, please use the Q&A feature at the bottom of our screen. And as time allows at the end, we will address as many questions as we can. Again, thank you for joining us. Very, very, very strong panel of leadership in our industry today. And it's my pleasure now to turn it over to David from Proformex, who is going to kickstart our session. So thanks a lot, David. I'll turn it over to you.
Great. Thank you, Brian. Great to be here today. I'm David Morris, Chief Marketing Officer at Proformex. The celebration of Life Insurance Awareness Month is especially relevant right now with COVID-19 as the backdrop. This pandemic, among other things, has illuminated the need for protection and financial security for families all across the globe. And while that protection is present in consumers' minds, it's important to educate them better on life insurance, what it does, why they need it, and how we can help as an industry. Educating clients helps them to make better decisions that will keep their families' finances secure for the long term. Today, our panelists will be discussing the poignancy of this year's Life Insurance Awareness Month. They'll share ideas on how to best honor Life Insurance Awareness Month, chat about industry trends, and offer their unique insights as to what the future holds for life insurance. So without further ado, I'd like to introduce our panelists. My first introduction, Marc Byrnes, Chairman Emeritus of Oswald Companies. Under Marc's leadership, the 127-year-old employee-owned company has enjoyed significant growth and strengthened its position among the 40 largest insurance brokers in the U.S. The firm is also ranked among the elite top 10 privately held brokers in the country specializing in life insurance, employee benefits, and retirement plans that was founded by Marc when his agency merged with Oswald in 1987. And though the company is 127 years old, Marc is not. And Marc's also a very good friend of ours as well at Proformex. So Marc, thanks for being here today.
My honor.
Great. Next up, one of my newer friends in the industry, Ryan Pinney, president of the Pinney Insurance Center. Ryan is a 12-year $1 million roundtable member with 12 top-of-the-table qualifications, recognized for using innovative technologies to drive insurance sales. Ryan has also been honored as an Advisor Today 4 Under 40 financial advisor, and by Life Health Pro magazine as one of the 24 most creative people in insurance. Ryan has also served as a national trustee for NAIFA and divisional vice president of the $1 Million Roundtable. So I would imagine with those credentials, many of you are familiar with Ryan here on the NAIFA organization. Ryan, thanks for being with us today.
Thank you for letting me participate.
Awesome. All right. So one of the movers and shakers in the insurance industry from a tech side, Ken Leibow, founder, chairman, and chief executive officer at InsurTechExpress. For those of you who don't know, which is probably very few of you, but Ken brings more than 33 years of insurance industry experience with an extensive background in insurance technology for distribution and back office systems. Prior to founding InsurTechExpress, Ken worked for Genworth Financial, Mutual of Omaha, and as vice president of operations at Diversified Underwriter Services. Ken, thanks for joining us.
Thank you.
All right. And last but certainly not least, Mike Pepe, the founder of Proformex. Mike capitalized on his nearly 20 years of life insurance expertise by launching Proformex, the leading in-force policy management platform, helping agents, advisors, broker-dealers, insurance brokerages, and financial institutions monitor and manage their life insurance policies. Prior to founding Proformex, Mike was a leading agent with Mass Mutual before going independent and starting River Financial Group. Mike, as always, good to see you, and thanks for joining us today.
For sure. Thanks, Dave.
All right. So we have a lot of ground to cover. And so the first question, Marc, I'm going to tee this up to you. Literally with everything going on in the world, this year's Life Insurance Awareness Month is probably as important as ever. if you wouldn't mind, would you give us like just a brief history of the industry from your perspective? Because I think it's unique to everybody's here. And how does that look any different than it did 10, 15 years ago?
Sure.
Yep.
I may actually drop back further than that, everyone. In the 70s, there were 1,700 life insurance companies that grew by 20% into the 80s. Over 2,200 life carriers in the market. A number of those that entered the fray were actually property casualty companies that opted to get into the life business. However, by the turn of the century, the number of carriers actively engaged in the industry by the year 2000 was cut in half, 1,200. Back when I entered the business 44 years ago this month, whole life, life paid up at age 65, limited pay life, endowment at 95, yearly renewable term, 5-year renewable term were the only products available in the marketplace. Think about that. And these policies with very stringent medical underwriting and limited retention levels were issued by a plethora of AM Best rated mutual life insurance companies who battled to have the best 10-year and 20-year net payment and surrender cost indexes, which resulted in many of these carriers making highly aggressive dividend projections, which led to new rating agencies like Duff & Phelps, Standard & Poor's matched wits with AM Best to hold these carriers accountable. Once stellar and venerable carriers such as the Connecticut Mutual, New England, Mutual Benefit, Mutual of New York, Bankers Life, Phoenix Mutual, and many others overinvested in Northeast and New England real estate, which ultimately tanked dividend performance and adversely impacted reserves. By the mid to late 80s, many of these carriers couldn't compete per se with the new wave variable universal life insurance products offering 10 to 20% interest crediting rates, coupled with premium flexibility and low-cost loans and withdrawal rights, underwritten by carriers such as Cigna, Transamerica, Sun Life, Manulife, to name a few. Add to which the gunslinging new money life insurance companies appeared on the horizon. They burst onto the scene with investment portfolios built by junk bonds. They offered non-medical, interest-sensitive, guaranteed issue replacement products. Think about that. In addition, by the early 90s, many of these large mutual carriers got stung by claims resulting from the sale a decade prior of mispriced individual disability income policies with own occupation specialty definitions for professional executives. Fast forward to that today with long-term care. So the go-go era of what was once sold to the consumer as vanishing premium contracts resulted instead with vanishing carriers and vanishing captive agents. The large general agency system became a financially expensive dinosaur, and the cost to train new agents was completely decimated. As producer groups were born, such as Clark Byrnes, M Group, etc., independent brokerages, as well as wirehouses and banks, became the new distribution system. Fast forward to today, only the Northwestern Mutual, Mass Mutual, New York Life, and Guardian are still training new producers. And so are the wave of new products such as Indexed Universal Life, Variable UL, and the resurgence of whole life with guarantees with long-term care riders. And of course, 10, 20, 30-year new term products are now in vogue. Gentlemen, a lot, and ladies, have changed in the last 44 years, and it's going to change even more as we go forward.
So so along those lines, so looking forward, that was an interesting history. Just in the immediate short term, and I'll let you speak first to it, Mark, but I'm interested to get Ryan and Ken's perspective on this as well. Like in the next year to 5 years, where do you see all this going? I mean, you mentioned some consolidation and stuff like that. What else are you seeing?
I think you're going to continue to see consolidation with a lot of the once upon a time life carriers. Take ING of America, which has since become Voya. It'll be interesting to see what happens with their product portfolio and offerings, as well as this consolidation keeps shrinking, because most of the major insurance companies, I think my other distinguished members of the panel would agree, they're all looking for assets under management. They're training their agents, if you are, in the world of managing investments, not necessarily training them to become prolific life insurance salespersons in the area of estate planning, charitable planning, executive funding for COLI benefits, things of this nature. But I'd love to hear from the others.
Yeah, Ryan, you want to chime in on that, where you see, for lack of a better term, the new normal, or whatever that term is at this point, the normal. like this year, next year, moving forward?
You know, it's interesting where I think the industry has gone in the last 5 or 6 months is where I thought we'd go in the next 5 or 6 years. So, you know, simplified underwriting has become the new vogue product, right, or in vogue product. And, you know, we're seeing kind of a repeat, I think, of some of the stuff that was happening in the 80s when companies were trying to be super competitive. But what's really interesting is when you listen to the numbers that Marc talked about, going from, you know, up to 2,200 carriers and now down to 1,200. And I think it's probably you know, less than that today, probably more like 800 or 900 today. The GA space has done much the same, and the IMO space is now starting to follow suit. And you're seeing companies out there acquiring, you know, all of the firms in a specific category. Integrity is doing that now with like the final expense distribution marketplace. We're seeing that really with IMO groups. 2 of the largest, Bramco and LifeMark, merged at the beginning of this year, really creating the largest IMO group in the country. And so when you look at those things, I think that that's going to accelerate. And I think that what's going to happen is that as the industry continues to consolidate, that you're going to see some new entrants obviously coming into the marketplace. You're going to see a big swing towards direct to consumer distribution. Carriers have kind of always wanted to figure out how to do that. Fortunately for us as advisors, they don't really understand how to market or talk to the consumer. And so that's good for us. And it creates a barrier for entry to the carriers doing what they'd really like to do, I think, which is eliminate advisors. But it means that the brokerage agencies and advisors need to start becoming very tech savvy. And I heard a quote, so I'm going to steal it from somebody else, but the quote was, technology will not replace advisors, but advisors who use technology will replace those who don't. So I think that that's where the whole industry is going, whether that's at the agency level, the carrier level, or the, you know, independent agent, or even the career agent. Really, technology and the ability to use it effectively to be able to leverage it to get in front of clients is really where I think the industry is going. And it's happening at a lot faster pace because we just had 5 or 6 months of COVID, making it so that really the older age group of the economy, who was kind of timid about using technology and buying online, they aren't anymore. They had to for the last 6 months. They think it's cool and they want it, and they're coming hard.
Interesting. So Ken, you see, your company per se is in the technology world across
Sure.
the spectrum, right? So
Yes.
if, you know, how's the future looking on that right now? What are you hearing and seeing from your partners?
Yeah, and I'm seeing some of it similar to what Ryan said. I mean, I'm seeing, you know, with the predictive model underwriting, I believe we'll see quicker processes with more instant issue on more life products, not just low face term and final expense. And since millennials will be the biggest consumer base, one trend for sure is that there'll be more consumer self-service technology for buying and applying for life insurance, but with on-call availability of a professional agent to assist as needed. So we're still, it's kind of like a direct to consumer, but maintaining the agent ecosystem, you know, these e-retailers and I, you know, over the course of the next several years, definitely see that trending up. So
Nice. Mike, what are your thoughts on that? I know you're on the phone or on Zoom, or not a phone anymore, Zoom call, you know, 5 times a day as well. What are you seeing over the next year plus?
Yeah, no, for sure. Technology is going to play a huge role. It's a different way to interact with people. You know, it's harder to get face to face. So, you know, leveraging technology, staying in front of your clients, getting back to the basics, protecting the client's needs, and doing the right thing for the client. You know, like Ryan said, you know, the older generation as well is getting used to technology and the new way of doing business. And I think it's here to stay.
Yeah. So Ryan, I'm going to tee you up here. We were talking a little bit about the, you know, you had mentioned that what you thought was going to happen in technology over the next 5 or 6 years has happened over the COVID has actually expedited that in 5 to 6 months. What are some other ways which the industry as a whole is changing as a result of the last 5 or 6 months? And how's that affected your business?
You know, our business is actually up. And I think that if you look at the industry, many agents and agencies that were really what we would have defined as traditional agents or agencies, face-to-face meetings, paper applications, heavy in kind of the way it's always been done, really have struggled. And those that look like us, where we were very tech driven, we were using e-apps. I mean, 85-90% of the total volume of our business is electronic applications. So when you look at that difference, for us, and I think for those who are in the tech, kind of in that tech forward thinking approach to the business, it was an opportunity and remains an opportunity to grow market share substantially. The fact that we knew how to market online, the fact that we knew how to talk to consumers and in a virtual environment, the fact that we were already using desktop sharing and virtual meetings and had been for the last 6 or 7 years, the fact that we use e-applications, e-delivery, all of these technologies really have put us, I think, in a position where we haven't stumbled at all. I mean, we made the decision at noon on Friday, the 13th of March, to go virtual. My whole office was remote by 5 p.m. that day. And so 70 employees were remote. We didn't miss a beat. We started work on Monday just like normal. We just weren't in the office.
Yeah.
So I think
obviously those that were ready for that, had at least some semblance of being able to work through technology, had a huge competitive advantage at that point.
For sure. And I think the carriers that were in that same kind of mindset, there are some carriers that were definitely more forward thinking about technology and had been for the last decade or so. And those are the carriers that if you look at them today, their business is up. In fact, a lot of them are actually negatively impacted by the huge influx of business that they've received. So their cycle times and the time it's taking them to actually underwrite or deliver a policy has increased kind of exponentially, but their process is still superior to some of the other carriers who are like, well, we can't underwrite you if you're over age 70 because we don't know how to do it non-medically, and man, we can only go up to $500,000 or $1 million. So all of a sudden those market competitivenesses with technology apply to the carriers just as well. Yeah. But I also think you look at some of the companies that we thought were tech savvy. One of the big losses this year happened in July, and it was the loss of EMSI. So you have a big exam vendor that many of us knew who were also doing the telephone application process for some carriers. And because of their reliance on the physical exams to kind of prop up their business model, as soon as physical exams stopped, I mean, it took 2 months for them to fold. That's scary to think about what else is coming that we haven't seen yet. And I think there's a couple major BGAs and a couple major carriers and maybe even 1 or 2 major IMO groups that are really struggling and are already off 20 or 30% year over year. And if that's the case and they end the year that way, they may not be here next year.
Yeah. Well, I'm going to save that particular topic for a question down the road, because I actually am interested in digging more into that if we have some time, the consolidation aspect. Marc, from your perspective, in a company that's just much larger and been around, is more mature, how has, since COVID started, how has Oswald adjusted in their thinking from 6 months ago to now, and how they're doing business, and what kind of effect has it had on the business?
Yeah, thanks for asking. Being a full service agency, we have operated as a COVID resource center, and think this through: business interruption, the volatility of the stock market, in communicating with our employees and their retirement plans, our clients, 401k, 403b, companies that are furloughing or eliminating employees, how best to handle their benefits. We have moved into a high-level virtual communication with our clients proactively. And as a result of which, we have gone through massive retraining with our own salespeople, our business development people, to help them understand that now is an excellent time to be able to gain access to, quite frankly, people that have very challenging schedules, high-level executives, owners of businesses, CFOs, CEOs, et cetera. They're now available, inclusive of a lot of the young partners in the major firms or professionals. So actually, COVID has its own silver lining, albeit horrific, and something that we all look forward to having this pandemic end like yesterday. As LeBron James says, we should just cancel 2020. In some respects, I think we've learned to operate at a high virtual level, cut way back on expenses, travel, entertainment, and have found a way from which to be able to consistently increase our revenues retain our clients, and do so with a heightened level of webinar communication and high-touch Zoom calls.
Interesting.
Yeah.
It's always the one thing that I've heard on a lot of the meetings, webinars, whatever I've been on, is the ability to, like you said, there is a silver lining to this. Is that the accessibility of people, right, is there. They're not out of their office traveling. They're not this. They're like, all right, you know, if I'll give you 10 minutes, I'll give you 15 minutes. It's if you have the ability to meet them where they are, right, it's probably as good a time as any to reach them and be able to pitch, provide your value prop / provide that expertise.
Yeah,
that's great.
I would say, you know, it's that availability, but you know, what we're seeing more owners, policyholders, they want that holistic approach. They want to look at everything. You know, now's a good time to really dig deep and see how everything ties together. So I think that opens up a lot of opportunities for new product sales as well.
Can you expand on that a little bit, just from a standpoint of how you see it from a Proformex level?
Yeah, you know, it's more tied into holistic planning, financial planning, being an advisor, you know, not just selling an individual project. You know, how does this fit into your overall needs and objectives, short-term and long-term, and, you know, how do you continuously monitor that and stay on top of it? So for us, it works perfectly for, you know, ongoing proactive in-force monitoring, tying back to the client's needs, and really identifying where there's gaps or opportunities in their coverage.
Yeah, I'll give you a specific on that if I can, just to take on what Michael was saying and complement it. Think about the consolidation of a lot of these carriers. And I don't know if any of my friends, Ryan or Ken, want to weigh in on this, because I want to be as discreet as possible. But a lot of these big boy carriers right now that absorb blocks of business are now changing the internal mortality rates and significantly increasing what was once a Jeff Pilot product or another type of carrier's product. The Chubb contracts that were out there, people thought they were buying X mortality rates. Now they're Y plus Z. A lot of changes going on. Why? Because the big boys that have acquired them are making decisions that we're suffering adverse experience. Therefore, it's time from which we need to go back out and increase these costs. And a lot of policyholders, consumers, are completely unaware of this. And a number of the brokers and the agents that were servicing these contracts aren't even around, or they're retired, or they're part of wirehouses where they didn't even know the right questions to ask. So I think that kind of ties in, Mike, to what you were saying, and love to hear what the other guys are seeing at this point. Plus, the whole world of reinsurance is going to be really rewired. I'm interested in knowing how that's all going to come down in the next 2 to 3 years.
You know, there's actually a question in chat, and it basically asks kind of a similar question, which was, you know, how does marketing permanent products and how does adjusting premiums and benefits impact those benefits, right? Or the product performance, I guess, is really what they're trying to ask. And, you know, this is something that I have been frustrated with as a new member of the industry when I first joined nearly 20 years ago, right? Everyone talks about doing in-force, you know, policy management or marketing or annual reviews or whatever terminology is the one that's in vogue and popular at the moment. It all means the same thing in my mind, which is take care of the clients you sold stuff to a long time ago, right? And I think that there's a huge challenge in our industry, both at the advisor level and at the carrier level, that it's really hard to get accurate data, especially as there's been this consolidation of carriers. You know, you mentioned Jefferson Pilot. It's easy to pick on them. Maybe I sold the Jefferson Pilot policy to a client, you know, 15 years ago, and I have to call, and I can never remember who to call. You know, which carrier bought who, then who bought them, and then who bought them. And so you start going through this chain, and they go, oh, well, we actually didn't buy that block. That block went somewhere else. And, you know, so it gets really frustrating and difficult to try to manage these policies. And part of it is that I'm trying to do the right thing, but most advisors, frankly, sell a policy and move on. And there is no in-force management. There is no ongoing, hey, premiums are changing, rates of insurance are changing. And the carriers do a lackluster job of making their client communications easy to understand and read. And, you know, that there should be a big bold, pay X dollars more or your policy will lapse, right? And they kind of bury it in legalese and tables of data, and it's like super hard to understand for the typical consumer. So I think there's a huge opportunity for the industry, and I really shout out to Proformex here. what you guys are doing is designed to fix that problem for the agents that care about their clients. And I think that's laudable and commendable, and but it's a big lift, right? And we as an industry need to get behind the companies that are trying to do the right thing and help promote them with the carriers.
Yeah, and I just wanted to add to that, the carriers that I worked for, and even recently, our in-force projects were just about not having an 800 number to do send out a policy owner change or change a beneficiary, and just build out a client account portal where they can automate that. That's not client engagement. That's just automating the process, but the client still has to initiate it. So to understand market changes, event changes, and things like that again, that's what Proformex brings to the table. So carriers are just kind of building out those client portals, but they're not doing that engagement piece to help the client in some of their direction on their current policies. So
I think the other part of that too, and I think, Ken, you hit it pretty close to the mark there, which is they're not trying to service the client. They're trying to provide the client a way to do whatever they want with the least amount of cost and energy and effort to them as the carrier. And one thing that advisors need to remember is that there is built-in mortality rates in products, right? And that's what we sell, but there's also built-in lapse rates. The carriers have already assumed that there's going to be a certain amount of lapse, and anything above that number benefits their bottom line. So they don't have a lot of reason to sometimes do the right thing. And that may sound like a dig on the industry or the carriers. It's not, it's just the way that the math works. And we as agents and advisors really need to take the responsibility for what we sell to our clients, and frankly, what the industry has sold to our clients, and make sure that we're doing a good job in educating both the consumer and each other to know what's happening.
Yeah, I mean, along those lines, Ryan, you're spot on in terms of helping our clients understand what they have to continue to put into these policies in order to sustain them. Recognizing you talk about new wave, let's talk about life settlement. Let's talk about retained death benefit. Let's talk about these new pockets of investment pools that are out there with humongous entities, private equity firms, the Apollos, the Abacuses, et cetera, that are throwing billions of dollars into this world right now. And they are creating opportunities for our clients to potentially do something that is in their best interest, i.e. take a policy that's in trouble, depending upon the health and the situation of the insured, to sell it, maybe provide early beneficiary assistance to decedents who are not dead. I mean, think about where our industry has unfolded just literally in the last half decade. It's unbelievable.
Right.
And the other thing that I want to ask the group is, let's think about market capitalization. Who are really the largest insurance companies in the world? They're in China, right? Think about the largest life companies. I was looking just this up the other day. Ping An, China, AI, Hong Kong, China Life, Prudential UK, then Metropolitan. And then you find, Aflac down the line. I mean, boy, I'll tell you, the world has really changed in terms of who ultimately is going to be providing us with product from which to be able to distribute it in the future.
Yeah, it was interesting. I've had a couple opportunities to speak and do things in Asia, thanks to MDRT. And one of the things, like Ping An, you mentioned, I think the last I heard, they have over 1 million active producing agents. Wow. One carrier, and they're captive agents. So it's not like they're independents and they just happen to have 1 million guys with contracts. These are captive agents selling insurance in China. And people don't really understand the economy of scale in India and China both. I mean, there's a couple billion people there. They've got more agents for one carrier than we have in our whole industry in the US. Their middle class is as big as the population of the US. Like all of a sudden, the economics of that are totally changing kind of the game. And what's really interesting and also kind of scary at the same time is there's a lot of stuff happening outside the world. I think we have probably a question about this, David, somewhere about regulations and regulatory stuff happening in the US. And it's funny because none of it's new. If you look to Australia, if you look to the UK, if you look to Canada, which a lot of people would go, well, how does that impact the US? Well, those places already have done all the things that the US is now trying to implement. So, you go back a few years ago in Europe, they put in Solvency II, which was then kind of created to how carriers in the US had to retain earnings and report capital, for claims paying ability, and like all these things impact us. And we a lot of times as industry are very insular and kind of head in the sand mentality of, well, we're in the US and those other things don't matter. But in reality, the technologies from China and a lot of the Asian insurance companies are now flowing into the US as insurtechs. I'm sure, Ken, you could probably talk about a lot of that. And it's really interesting because if you look outside the US, you can figure out what's going to happen in the US almost to the exact detail of this company is going to come here and offer that product.
Yeah, so that's a really good segue into we were going to talk about Reg BI implementation, or the SEC's Reg BI date came out just, I think it was a month ago, a little over a month and a half ago. So going forward with that conversation, what impact will Reg BI have on our industry going forward? I know it just started, but Mike, why don't you take that? I know Ryan, and we'll go through the panel on that, because I think it's a pretty it's an interesting topic, especially with the panel we have here from everybody's lens.
Yeah, it's a national standard. Each state had patchworks and had their own things, and it was very confusing. And what I need to follow, with Reg BI, it sets that national standard there. It's all about the client's best interest, doing the right thing for the client, and it's continuous. It's not just sell it and forget it anymore. You're making recommendations. Even if you don't make a recommendation, that's a recommendation to stay in that product. So, it's holistic. It's not just, how's it fit in their entire plan? You're going to be able to, and you're going to have to be able to sell multiple products. You're going to have to be an independent advisor that, finds the right product and solution for the client's needs. It's all going to be about a process. What's your process for making recommendations? How is this documented? What's going on when you come up with these recommendations? So I think it's great. I think it was needed. Again, it's going to help the client's best interest. And at the end of the day, the beneficiaries are hopefully going to win in the deal. So with that, Ryan, I'm sure you see a lot of this too. So, what are your thoughts on it?
Yeah, I think regulation as an industry is only going to get more stringent. I have a lot of friends in Australia, and I've been watching what's going on in their market, and I actually think that they're probably the closest market to us right now, and kind of product distribution. They're obviously a lot smaller, but one of the things that they just did over the last 8 or 10 years is they kind of started with something that looked a lot like Reg BI, this best interest standard. And then they immediately went from there to starting to target commissions. And they actually forced the entire industry to cut commissions and start structuring commissions instead of being lump commissions to being level commissions, where you started getting renewals as a big stream. And then with that, they said, oh, you only get the renewals if you're actually talking to your client at least once every other year and getting them to sign a document saying you're still providing advice to them and helping them. So there's that forced annual review and maintenance of policies. And now they've gone a couple steps further, which is when you sell a product, you have to write up a big statement of advice, and you have to compare and contrast multiple products before you can offer the one that you want. And because of that last step completely eliminated their captive insurance industry there. You now have to be an independent multi-carrier broker to be able to comply with the regulations. And so I look at it, and I've seen attempts both in New York and California and Florida for things like commission disclosure or even reduced commissions or commission regulation. New York is a prime example. Max commission rate there is 99%, regardless of what the carrier may pay elsewhere. And you start looking at some of those things and changing what's going on with Reg BI and best interest standards. I think we're right in the midst of that, and we're just a little slower because our government tends to move left and right, and every time you swing one way or the other, you get a bunch of regulations one way, and then you kind of repeal some of them, then you kind of go back the other way, and you just keep doing it. But we're slowly moving to that type of economy. And so think about, as an advisor, if that happens, what does that do to your commissions? What does that do to your block of business? What does that do to your portfolio and how successful you are as an advisor? And it changes substantially. And I think this best interest, getting in front of any kind of regulation and understanding it before it kind of goes into effect, again, gives you that advantage, just like technology did when COVID hit. So, you can structure your business to operate a lot differently if you think or know that that stuff's coming down the road.
For sure.
That's interesting. Mark, or I'd love to get Mark or Ken's input on that, on what they think about the status of Reg BI and what it means moving forward.
Go ahead, Ken. I'll be the cleanup batter.
Well, yeah, I mean, I just talked to it from a technology perspective, and we all remember the DOL and all that stuff that went on before, and every time we see this as a technology vendor, we like this regulation chaos because it means you got to do more, changes to platforms, and in the financial institutional channel, everyone has all these suitability and that analysis type applications and things like that in the pre-sales process before you start quoting and things like that. And as far as I'm concerned, is that as there's more regulation that and Ryan said that it changes, goes back and forth, which is true. But as it gets implemented, then you have to then add more of these tools. You also see more vendors integrating solutions, because one vendor may be more on the quoting side, and you have your sales, more of the consumer sales tools, and building all of the, not just needs analysis, but all of the, as we're talking about best interest, these other types of analytical tools, and integrate it into the process. And then you build a process around it before you get to the part where you actually write an insurance application. So that's my perspective on it.
I think everything that's been stated is absolutely pointed and poignant. I'm going to say something that could be very controversial. I love it, and I'll tell you why. Transparency is really critical. And I think from an E&O, errors and omissions, fiduciary liability perspective, it is incumbent upon ourselves to clean up ourselves. We are selling an asset class, no different than our friends, frankly, who are in the investment business. And I think it is a terrific opportunity for us to train our brokers and our producers in a way that really is what I would call consumer driven, consumer focused, and very consumer friendly. So I view this as a great opportunity for us to, quite frankly, clean up our own house. And I see nothing wrong in looking at levelized commission contracts. That way you're going to keep a lot more business on the books. I know that there are certain entities out there that are actually thinking about factoring. They'll buy out books of business if they see level commissions. We've seen that for years in the property casualty and in the recurring revenue business we derive from employee benefits or our retirement plans business. But I think it's a really good thing for the industry. I hate the idea of compliance and regulatory mandates state by state, but I think this is a good thing for us.
Great. So I'm glad we still have a little bit of time, because there's one other, we started to touch on this a little bit, and I wanted to get a little bit deeper dive when we were talking about the changes and trends that we're seeing in the industry. And Ryan, you had brought up around the consolidation in the industry, from carriers to IMOs, BGAs, et cetera. Would love to get a little bit deeper dive into that and get your perspective on a little bit more granular on where it's going, how that's going to affect the entire ecosystem from each one, from the carrier to the IMO down all the way down to the agent level, advisor level.
So let me kind of break.
Loaded question. Sorry, probably.
Yeah, it's a really big question, but if you kind of focus at distribution as the segment here, right? Mm-hmm. So distribution, most carriers think they're in distribution, but the reality is they're not. They're manufacturers, right. And they're even like a TPA or administrator on the back end, but they're not really in distribution. And the way you can kind of see this is, has a carrier ever built a product that didn't sell? And all of them have, because they don't actually understand distribution. But in distribution, when you start looking at the IMOs, the BGAs, all the way down to the actual individual agent on the street, what happens is this really interesting thing. All of them directly interact with the consumer on some basis in the sales process, right? And it's that sales process that really is distribution. Well, what's happening in distribution is massive consolidation, and you don't really see it today, but just for some people who may not know, the two of the three largest IMO groups, Bramco and LifeMark, merged and became Libra. And most people are like, what does that mean? I don't even know. Well, that means that 60 or 70 of the top insurance agencies, BGAs or FMOs or whatever term you want to use, it's really the same, merged into one large group and now have economy of scale and technology and access to carriers that puts them ahead of a lot of other of their peers. So the natural reaction to that is that the other IMOs have to look to do something similar. So now you're going to see other IMOs do it. And you saw Ash join AIMCOR. You are now seeing some of the other smaller groups looking at each other going, well, hey, we're not quite big enough to get the same economy of scale as Libra or the Ash AIMCOR combination, or maybe Crump. What do we do? And so they're looking at consolidating. So I think today you're probably looking at, call it a dozen legitimate IMO groups of any decent size or scale. I think in the next couple of years, that'll be down to 6 or 7. And I think when you look at the career agencies, and when we've seen 3 or 4 of them kind of exit that career agency market in the last couple of years, again, because carriers aren't great at distribution, I think you'll probably see another 1 or 2 do it. They'll probably do it through consolidation or merger. So whether that's a principal buying a guardian or something similar, doesn't really matter. You'll see that happen. And then on the BGA world, we're already seeing it. My father started our agency, and Marc, you're kind of in the same age group where, you start getting into your 60s, late 60s, 70s, even into the 80s with some of these agencies as the principals, and they're looking for an exit. And some of them are lucky. They have someone like me who's stepped in behind them, family member or close person that they can trust that will take over the agency, but many haven't found that. And so the only action they have is to either fold, close the doors and retire, or consolidate with somebody else who has that growth mindset for the future. So we've seen that in the BGA space already. IMOs, FMOs, Integrity has bought, 100 agencies in the last 2 years. There's other groups out there doing it. We're now even starting to see InsurTechs and venture capital companies come in and say, hey, one of the things we're struggling with is we want to build these cool products, but the carriers won't talk to us because we don't have distribution. So what are they looking for? They're looking for BGAs they can buy to get distribution to help them accelerate the advancement of the technology into the insurance space. So hands down, absolutely, mark it in stone for sure. Consolidation will continue, and I think it will happen at an even more accelerated pace because COVID proved that you have to have tech, but it also proved that most of the current industry distribution partners weren't quite prepared. And so the InsurTech world, the FinTech world is really like salivating and looking at, man, we can come in here and fix a lot of these problems if we had access. So I think you just see IMOs and BGAs consolidating with each other. I think you see InsurTechs coming in and picking off the kind of the cream of the crop. And I think you see whole niche segments like final expense being consolidated under a single distributor, trying to really run the table and the market and get all of the leverage and advantage for having what amounts to 100% or near 100% distribution cloud.
And Dave, I just wanted to add something to that, which is another thing you see as a result of these consolidations is you do see some centralizations around business processing operations, where so they kind of model it where, okay, they've got these acquisitions, they're going to focus on sales and marketing, and we're going to bring in new business and commission accounting, for example. And then they may select a preferred technology vendor or build something on their own. I'm not going to name, some of the IMOs have done it, like a multi-carrier e-app platform, or even an agency management system back office that would be used around its memberships or acquisitions. And so that kind of also, from a vendor perspective, either creates a competition or some bigger market share of their solution set against their competitors when some of this consolidation happens and they consolidate from a technology perspective or go single vendor, for example, or homegrown.
I think, Ken, you're spot on there too, because the industry has it's funny, producers talk about PUPS, P-U-P-S, products, underwriting, process, and service. BGAs talk about CUPS, C-U-P-S, which is commission, because that's what we pay the producer, underwriting, process, and service, right? Products and service. It's like, we all talk about the same stuff. I mean, it almost has become a commission war a lot of times in distribution. So the ones that are trying to differentiate now are trying to move to, I think, what amounts more to like a model of TIN, which is technology, infrastructure, and network. And so the top BGAs and IMOs are really moving to this technology and infrastructure based model, and then figuring out how they can network their best producers with other best producers inside their groups to kind of leverage each other's best practices. And it's funny because if you look at that model, there's not very many people in the space today. So it's kind of blue ocean, and these agencies and these tech vendors are really growing rapidly. And they're going to be in that space where all of a sudden everyone's going to look around and go, uh-oh, we're so far behind, we don't know what to do now. And it's funny because you look at this happened 2 decades ago to Allstate, right? Allstate didn't enter the online market to sell home and auto products. It wasn't what they were wanting to do at the time. They couldn't figure it out. They weren't sure if it was going to stay, and so they didn't do it, early 2000s. Well, it ended up being $1 billion mistake because they had to spend $1 billion to buy insurance to catch up. That's a huge mistake, and most industries and most companies in the industry can't suffer that type of mistake and still recover. Granted, Allstate's got a lot of money, so they could, but many other carriers in that distribution model aren't going to make it. They're going to get consolidated up because they can't compete online, and it's going to happen in the life space, and it's going to happen in the robo advice space, and it's going to happen, in health and benefits too. It's coming. It's here. It's like you can watch the model. It's going to repeat itself over and over until the whole thing is distribution is really changed.
Mike or Mark, did you want to add anything onto that? If not, no big deal. Because we got running short on time because the discussion's been great. I want to get to just a couple of questions while we have a few minutes left. All right, so there's a question from one of our attendees. I'm not sure who to direct this to, but it says, how important will tax law changes be to allow guideline and net single premiums be based on interest rates less than 4%? Mark, Ryan?
Yeah, I mean, Mark, maybe you can jump in on this, but my first thought would be that tax law has some impact on product design, but the problem right now is not product design. It's actually the bond market, right? Bond market is so depressed right now that insurance companies offering guarantees of 3 and 4%, it's just not sustainable, not practical. I mean, they can't buy the guaranteed part of the investment that they need to in the bond market. That's how they typically do that. And so because they can't do that, I think you see a continuing trend to index-based products with low guaranteed interest rates, 1%, maybe even less if it gets too much worse. And that the hope is that you make your interest in the products from a permanent perspective. The interest comes through an index, or if you're a mutual company, it's coming through bond or through dividends instead of the bond performance. But at the end of the day, insurance companies still have to guarantee the minimum interest rates. They do it with bonds. If bond rates stay artificially depressed, which they have for basically a decade now, you just see interest rates moving lower and lower. And companies who said they would never come up with index products are now coming up with them. And you can look at companies like New York Life and even Northwest Mutual, either having developed or in process of developing index products because there's a big problem for them with interest rates.
Great. All right, one more question. I'm allowed out here. And Ken, I'm going to direct it to you here. What technology out there are you seeing making a difference in the producers' lives? And I appreciate you wanting to say Proformex right off the bat, but I think that's a given. So you can pick something else off that.
Yeah. And I don't know if it's okay to talk about a vendor or not, but where you can engage a client, you're selling them remotely, and yes, Proformex on the in-force side for sure. I mean, obviously that's going to help discover new sales opportunities and help maintain and take care of your clients. But in addition to that, on the sales process, I like that for a platform like Insight, who has an intelligent quoting system, but for more complex products like IndexUL, they have a presentation layer. So they're sitting there with their client remotely on Zoom, and they can visually, instead of showing a bunch of numbers and a ledger, they can visually show the impact of different carriers on different strategies around IndexUL. That's a more complex product. And so, and then I would advise every advisor, no pun intended, every agent or advisor to invest in a CRM that's already set up for your vertical. Most CRMs are integrating with quoting and EAP and everything else, all the main brands. I won't name them. Some of them are specific to the industry, some are more generalized, but there's a lot of them out there. And to maintain your clients, I think every agent in the field should definitely invest in a CRM and one that's integrating into these other sales and application for applying for insurance platforms.
Great.
So.
Ryan, I'm going to ask you the same question, just to, just to pick one or two and be brief about it, not to put you on the spot. Because I know you're generating a lot of business these days. What are you seeing? What are you using?
I think the biggest one, Ken, you hit on is a CRM. I mean, we would be lost without a good CRM platform. We, at the time when we kind of got into this direct-to-consumer marketing channel that we have as part of our business, those tools didn't exist, and so we had to build it. So, it's funny that we had to build what amounted to a CRM system to be successful. And now, 15 years later, you sometimes wish, man, I wish I had invested the money differently, but you had to have it to be successful when we were there. I think the other one is, if you're an agent or advisor, especially an independent agent with multi-carrier access, if you're not using e-application basically 100% of the time, you're doing it wrong. Because e-application drop tickets, I don't care if they're full app or drop ticket, that model is so much more efficient and effective, and people don't understand the difference, right? The carriers can take that right into an automated underwriting engine, which most of them have, and make a lot of decisions very quickly. And so underwriting cycle time is way faster using electronic than it is paper. And at some point, I think you're going to see, and probably have already seen, some carriers start cutting commissions if you're not submitting electronically. So I think those two, CRM and electronic submission.
Can I make one other point real quick? Because I want to just change the paradigm. I know we have a lot of agents on the call. For e-policy delivery, now, of course, COVID, you are remote. But for e-policy delivery, we are selling upsell and cross-sell opportunities. We know when you go to deliver a policy, you get referrals and things of that nature. So there's been some resistance to electronic delivery of a policy. But now, a lot of these platforms allow you to cross-sell and upsell. Since you're working remotely, try to also do the full end-to-end from e-app to e-delivery on your policies. So 70% increase in cycle time and higher placement rates as a result.
Nice.
Collecting the balance of premiums. So.
Marc, anything at Oswald from a tech standpoint that they've engaged in specifically that's really helped the last couple months?
I would say the advantage, a little different twist than both Ken and Ryan, has been proactive webinars, being able to get other advisory groups, the law firms, the accounting firms. Everybody is available now for these incredible, what I would call, updates. It was brought up earlier about the potential changes to the estate tax planning. You can bet on that. What might be coming down the line in the area of business interruption, just let your mind wander. I mean, go out and communicate. The private equity guys are all talking valuation these days, pre-COVID, post-COVID, depending upon the industry segment. How can you best educate them surrounding that? What's changing in the world of legal liability? I mean, educate, advise, be there as a resource for your clients. Provide them with information and guidance. Don't sell them stuff. Help them understand what's changing around them. And it's changing fast.
Yep. Mike, I'll leave the last word to you. Anything that you're seeing out there from all the people we talk with every day?
Yeah, well, I mean, we've seen it with our current users. The usability is up like 300% since COVID. People are going in there, they're minding their books of business. Their best prospects are their current clients, so they're leveraging the technology, the reviews to, make sure their clients are protected, but uncover new opportunities too. So again, leveraging technology to make your life easier and focus on the things that you do best, prospecting and selling cases. So.
Awesome. Well, on behalf of everybody at NAFA Proformex, I want to thank Marc Byrnes, Ken Leibow, Ryan Pinney, Mike. Thank you so much for joining us today. This has been a great conversation, and I know you guys have spent a lot of time preparing for this, and I think it came across really well. So again, on behalf of everybody, I want to thank you. I'm going to turn it over for some final words to Brian Steiner from NAFA.
Excellent. cranking the video there. Parts from all that talking I just did, fellas. Whew. And thank you guys, all of you, David, Ryan, Mark, Ken, and Mike, for spending some time with NAFA today. Fantastic information. Again, this is recorded and will be posted on nafa.org under our business tab. And very excited to have all of you. And again, our continued partnership and strategic alignment with Proformex. Fantastic application that I encourage everybody online today to check out. And I thank everyone on the panel for their participation with NAFA, their support of NAFA, and helping drive our industry forward. So thank you, everyone. Stay healthy, stay safe. And if you need to revisit this again, on-demand recording will be available at nafa.org. Thanks. Have a great day.